Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are higher. Let's welcome in now Jared Blickery, joining us to break down the headlines. Jared, what are you seeing in the markets?
We've got some small gains, and I think investors will take that. That's what's supposed to happen this time of year. Here's the Dow. This is a perfect example, up 160 points, or about 1/3%. Kind of choppy in there, but at the end of the day, if we're holding on to some green, that adds up. That compounds into the end of the month. NASDAQ, very similar performance return. You can see it was up quite a bit more in the early goings, gave some of that back. And the S&P 500 up about the same amount. Very similar looking chart to the NASDAQ. What is down today is the Russell 2000. So small caps, after notching those record highs yesterday, under a little bit of pressure today. S&P 600 though, just barely in the green. So small caps kind of mixed there. Also want to go over the bond market. 10-year T-note yield up 3 basis points to 4.14%. The 30-year up to 4.79%, up 2 basis points. They've been creeping higher recently, but not in an aggressive way, or not to a level that's really been of concern for investors. For 30 years, you want to watch the 5 to 5.1 level, and we are pretty far away from that right now. U.S. dollar index, a whole lot of nothing right now. And let's check in on the sector action, where we have, we'll get to this in a second, we got some record highs to talk about on that board, but XLC is leading the pack. That's Meta, that's also Alphabet, that's up 1.23%, followed by tech and then consumer discretionary. Those three leading sectors, those are the mega cap sectors. So large cap, especially mega caps, doing well today. Energy in fourth place, then financials, those are the outperformers. And what's not working, that would be utilities, healthcare, and industrials. So let's take a look at that NASDAQ 100 so we can take a look at the mega caps here. NVIDIA and Apple, two in the tech sector, not cooperating today, but we have Meta up 1.5%, Broadcom up 2.25%, Amazon and Microsoft and Google up less than 1%. And I got to show you the inside the tech sector. The chip sector looking pretty good right now. And here I am sorting by performance, and you can see we're looking at gains from under 1% all the way up to 5%, pretty healthy looking there. Here is the software board, and if I sort similarly by equal weighted, you can see pretty similar returns there. We do have some outsized underperformers here. DocuSign down 7%, Snow, Datadog, Teladoc, Shopify, those are all down more than 1%. For the most part though, looking pretty good. Here is the Dow, and aside from the mega caps what we just looked at inside the NASDAQ 100, we got Visa up 1.5%, Home Depot up 1%, Goldman Sachs almost 2%, and Salesforce, another outsized day for Salesforce, that is up 5% here. And I got to show you the transports, because the transports, the Dow Jones Transportation Index has been up 10 days in a row. That's if it holds into the close. And we are just seeing, it's not at a record high, but some of the ETFs that track it actually are, IYT. We'll get to that in a second. But here we have the airlines looking good. There's Love, Southwest Airlines up over 5%, American up over 2%, and Alaska Airlines up over 5%. So looking like a pretty broad mix today. And instead of the small caps, it's some of the larger ones today.
All right, thank you, Jared. Appreciate it. Well, Netflix set to acquire WarnerBrosDiscovery's studio and streaming assets. The company's announcing that they entered into a definitive agreement subject to regulatory approval. But will this deal be able to cross past the finish line? Here with a closer look is Reuters US entertainment business correspondent Don Chmielewski. Don, it is great to see you. So let's talk about this deal, Don. And it is a historic deal. Netflix buying Warner Brothers, $72 billion deal. $27.75 per Warner Discovery share. What do you think, Don? What does this mean for Netflix financially, strategically? Walk us through it.
Motivated this deal is really intriguing. You know, Netflix has always been a company that built rather than bought. But this, listening to the investor call this morning, Netflix's CEO, Ted Sarandos, was talking about how this represented a singular opportunity. And here's what Netflix sees in the deal. It's an opportunity to tap into a library that Warner Brothers has built over 100 years with some of the best named franchises, entertainment franchises you can name. Harry Potter, their DC Comics superheroes like Batman and Superman. But beyond that, Netflix sees the opportunity to acquire businesses it doesn't currently have. It doesn't have a studio. It doesn't have a film distribution unit, a company that's designed to distribute films into movie theaters and promote them. And with Warner Brothers, it would acquire this new capability to really broadly distribute its films. And lastly, there's the HBO Max streaming service, which it sees as a potential complement to Netflix's own service. Some data that we've had access to shows that 75% of HBO Max subscribers also subscribe to Netflix. There's not a tremendous amount of overlap, but Netflix sees the opportunity to potentially grow HBO Max, which now reaches around 130 million subscribers. That's quite a bit smaller than Netflix.
So Netflix picks up the library, picks up some very sought after IP. We also have to ask, Don, how we think President Trump might feel about this, because the perception was, the thinking was, well, Paramount, Larry Ellison, had this relationship with Trump, and that gave them this edge. In fact, and you saw this, CNBC is reporting the Trump administration views Netflix Warner Brothers deal with heavy skepticism. I'm curious what you make of that, and if you think, Don, at the end of the day, this deal really gets done.
So I'm fairly sure that Netflix is not going to put $70.2 billion on the line, and a nearly $6 billion fee that will be paid if it can't close the deal. That's a tremendous sum of money without doing some sort of diligence here. I know it's hard to predict how the Trump administration will view any deal, and certainly Larry Ellison, whose son David Ellison leads Paramount, was seen as having kind of an inside edge given Larry Ellison's connection to the Trump administration and how the Trump administration has lauded David Ellison periodically in recent months. But I think, but if the way that Netflix sees this deal, it doesn't, it will argue that, there may be concerns about consumer impacts. It'll argue that, bringing together HBO Max and Netflix actually will be a benefit for consumers because it can bundle those two offerings and provide them to you or I at less money. So that, it argues, is pro-consumer. We'll see what regulators think about that. That's going to be the test. And another test is how regulators define the market. Will regulators simply look at streaming services and decide that Netflix is too powerful among its rivals, which include Amazon and Apple and Paramount Plus? Or will it look more broadly at the ways people are entertained? And if that's how you define the market, you look at YouTube, which is currently far more dominant in American living rooms than even Netflix or indeed any other media company. So we'll see how it goes. But Netflix clearly must have some indication that it can get past these regulatory hurdles, or else it would not put this kind of money on the line.
Can I ask you, Don, also what you think Paramount's next move could be? I mean, if you placed your bets, do you think they go hostile, Don, or no? They lick their wounds and they target another acquisition.
It's there was a lot of there were a lot of angry letters circulating yesterday before the deal closed. It is entirely possible that we've not heard the last in this deal, but in talking with folks close to Warner Brothers, Paramount had an opportunity to increase the value of its bid. There were active discussions all the way through to the board's vote last night. Paramount did have the opportunity to outbid Netflix, but I'm told that Netflix was the top bid.
Let me ask you, Don, how much of a win you would consider this for WarnerDiscovery CEO David Zaslav? I mean, $27.75, that's not bad, Don.
That's a huge multiple for a business that was trading at $12 a share not all that long ago, right? It is, look, the whole sector is afflicted. You know this. The growth. This is a mature industry that needs to consolidate to remain competitive with all the other choices in our living room. So I think the bankers are pretty happy at the amount of money they managed to extract for shareholders. It was a big payday.
Last question, Don. We talked Netflix and Paramount. What about Brian Roberts and Comcast? I'm just curious, where do you think this drama all leaves them?
It's a really interesting question. I mean, as the entertainment companies grow larger, and these entertainment companies are increasingly competing with tech companies for rights to sought after content like the NFL. Those deals are going to come up for renewals soon, and we'll have to look at whether or not some of these smaller media companies will have the wherewithal to compete for the most valuable content that continues to drive the most viewers and who also attract advertising. So it increasingly, this industry is dominated by large players. So we'll see if some of these other players who are not quite at the same scale will be driven to some sort of some further consolidation.
Don, great to see you. Great to have you on the show today. Thank you.
Thank you for your time.
Well, a massive shakeup is underway in Hollywood. Netflix agreeing to buy Warner Brothers' legendary studios and HBO Max in a landmark $72 billion deal. And joining me now is Yahoo Finance senior reporter Allie Knell. Allie.
Yeah, Josh. So I've been digging into the regulatory aspect of this because that seems to be the big looming question moving forward, especially for investors, whether or not what regulators will even let this deal happen. So the combined Netflix Warner Brothers company that would control roughly a third of all U.S. streaming engagement. That's according to a report from Just Watch. And that's already drawing some political fire. So we have a statement here from Senator Elizabeth Warren, and she said, quote, "This deal looks like an anti-monopoly nightmare, and Netflix Warner Brothers would create one massive media giant with control of close to half of the streaming market, threatening to force Americans into higher subscription prices and fewer choices over what and how they watch, while putting American workers at risk." We also heard from Hollywood unions like WGA. They are also very much against this merger, but legally it's a bit more complicated. So a former DOJ antitrust official told Deutsche Bank that under current case law, Netflix or even those competitors in the bids, Comcast and Paramount, they likely would have all prevailed if regulators tried to block their bids, meaning the DOJ may face an uphill battle if it wants to stop this at all. And we heard from Jason Bazinet from Citi. He was on the show earlier this morning, and he said the real flashpoint is the streaming share. So you basically have this largest streamer being Netflix essentially getting bigger. The studio side, he says, is not going to be a factor here when it comes to that regulatory overhang. So the regulators are going to zero in on the streaming component. And Wall Street is really viewing this as cautiously optimistic in the near term. They said the review could be long, politically charged, and obviously one of the biggest overhangs for shareholders when it comes to the actual deal, the size, the sheer money that's involved here. Laura Martin was out with a note from Needham, and she said, if you're looking over the past 1 to 3 years, you could say, sure, Netflix overpaid, but this is a 2-decade-long story. So Wall Street is really looking out further into the future, and when you do that, they're a little more optimistic.
Yeah, I wonder that. I mean, Paramount, and you know this because you covered the story backwards and forwards. I mean, the thinking was Paramount, Larry Ellison, had this relationship with Trump. Yeah. And that gave them the edge. And so I saw CNBC reporting today that the Trump administration views this deal with, quote, heavy skepticism. That does not sound great. I don't know exactly the levers Trump can pull, but he's president of the United States. He's leader of the free world. I mean, if he wants to, presumably he can cause trouble here. Yeah, and we already saw Paramount reach out to WBD earlier this week, basically calling the process unfair, saying they were favoring one bidder, aka Netflix. So now, and you wonder about it, is their move to go hostile now? I think so, and remember, Netflix is only going to be able to acquire the studios and the streaming side when the planned separation of WBD occurs in summer 2026. So we still have a long way to go, and then on top of that, you have the regulatory hurdles. So in the interim, I think you're going to see Paramount Skydance be more aggressive here because analysts that I've spoken with about this say Paramount really needed this. This was a fight that Paramount lost, and it's going to be a major problem moving forward. So David Ellison, the CEO of Paramount Skydance, Larry Ellison's son, he's certainly going to go after this, and there's going to be a few more hurdles to jump through before we get to the finish line. I'm very interested what Paramount's next move is, and Brian Roberts and Comcast, their next move. Maybe they team up. We'll see. Who knows? Thank you, Allie. Appreciate it. Well, coming up, we take a look at the latest market action on market domination. The S&P 500 rising for the fourth day in a row, banging on a door of a new record here. Joining me now is Matt Rowe, Man Group Managing Director and Senior Portfolio Manager. Matt, it is always great to see you. So let's start here. I get the big Fed meeting on deck, Matt.
Yeah.
Market is pricing in a more than 90% chance of a cut next week. That feels high, you say. Start there, Matt. Why does it feel high? Why does it feel mispriced to you?
Well, I think a purely data-driven approach would suggest that we don't need to cut interest rates, right? The economy is surprisingly resilient. Asset prices are at almost all-time highs. There's a lot of talk about stress in the credit market, but default rates are actually down in the last couple of months. So there isn't really this distress that would warrant cutting rates normally, but it's kind of been the path that we're on and has been the direction of travel has been to discuss this. Although I'll remind everybody that the last October meeting, Powell came out and said it's far from a foregone conclusion that we're going to cut in December. So that's what leads me to think that a 91% implied action for next week on the 10th is too high. But the market's the market. It's pretty efficient, and the equity market's certainly leaning on that potential for lower rates to keep driving higher.
Let's say next week, Matt, let's say they didn't cut.
Yeah.
No cut.
Yeah.
How does the stock market react to that?
I mean, I'd probably have to take the over on a down 2% move on the S&P, probably a little bit higher beta to the Russell, considering its exposure to smaller cap companies and more credit sensitive names. Long story short, risk assets would not be happy with that move. It's not disastrous, though. It's just another data point along the way. And really, the big question for me is how healthy is the consumer? Can what drives 2/3 of the American economy continue to power through an economy that there's a lot of negative commentary, but the actual data hasn't looked that bad?
Yeah, I mean, what is your base case for that economy? Because there's plenty of economists come on the show and they've kind of suggested Q1 GDP should be fine, kind of rebound from Q4, and they'll say, monetary stimulus, fiscal stimulus. They'll say, hey, that mega AI trend is intact.
Yeah.
So they sound constructive.
Yeah, I mean, I think the complexity of the situation in my view, is that there's this divergence of the haves and the have-nots, right? So a lot of consumer discretionary spending comes from a very small portion of the population. That's pretty resilient when it comes to equity market up and down and hiring and firing cycles. So it sort of masks what's going on for higher portion of the population, I would say. Broadly speaking, things don't look horrible. I wouldn't be surprised to see a mild recession in the beginning of 2026.
And the R word, I have not heard that on this desk in a while.
Yeah, I mean, look, there are a lot of people out there who are going to have a hard time making ends meet. And that's part of the way cycles work. We hear about this day in and day out on the affordability topic, right? The most recent off-cycle election that was just held in Tennessee, for both the Republicans and the Democrats, the number one issue was affordability. So there is a big part of our country that really is feeling the pain of higher prices. At the top end of the economy, where the market's pricing things, we don't see it as much, right? So there's more resiliency at the high end of the market, and companies have been able to weather this so far, but it wouldn't surprise me if we start seeing a little bit more weakening. So that really the push and pull to me is that you don't want to cut interest rates just to spur asset prices, especially when equities are at all-time highs. But we are seeing some softness in the labor market, which is kind of the bottom end of the market. More so. So it's complicated.
That's the one count I've heard, Matt, is there's folks have said, listen, they're going to cut because they are zeroed in that labor market.
Yeah.
They see weakening, and the argument you hear is, well, they want to move because central bankers feel like if that labor market gets away from them, it can get away from them really quickly.
And I think that's very true. I think with the dynamic in the market right now, it's probably harder to solve because the net beneficiaries of lower interest rates tend to be the top end of that market, right? So it's not like a direct injection medicine to the pain point, right? It's sort of take a pill and saturate the whole body. But the beneficiaries of lower interest rates really aren't the people they're trying to target with the policy. So it's a little bit difficult, I would say. I don't envy them for right now, for many reasons.
It's a tough gig. Let me get this bottom line then. So for investors listening right now, in this environment, against this backdrop, how do you want to position your portfolio?
I want to be less exposed to growth and momentum names, some of these aspirationally priced AI-driven narrative stories that that are pretty toppy, I would say right now. But I'm going to give a caveat. Alan Greenspan used the term irrational exuberance in 1996. It took 4 years for there to be a turn in the equity market in the year 2000. So the market can remain mispriced or rich longer than most people can remain solvent. So don't bet against the momentum in the market. I would say don't do anything drastic, right? Like steer a little bit more towards defensive names, steer a little bit more towards names that are more quality-oriented, value-oriented, maybe steer away from the toppy, AI trendy trades. But it's not going to stop tomorrow.
What about gold?
Man, what a story that is,
What
right?
a run, right.
So I have really been fascinated by gold and the relative value of gold for years, for many reasons. I used to challenge people on my trading desk, like, would you rather take 10 pair of running shoes or an ounce of gold? And just to spur thought on the topic. One stat that I think is fascinating is if you go back thousands of years, you can look at the ratio of where gold and silver has traded. It's been in a range of, call it 2-to-1 to 15-to-1. Right now we're at 72-to-1. It doesn't mean that we're going to revert back to something in between 2-to-1 and to 15-to-1, but I think you have to ask yourself the question of what's driving that valuation expansion, especially the relative value expansion away from silver and platinum. And I think it's driven by a huge desire to have assets that are held in a portable currency basket or currency neutral way. It takes it away from the visibility of tax authorities in a lot of cases. And people are worried about inflation, right? And gold has, at least academically, served as a pretty good place to park. If you look at the actual results, it's probably been less than what people would say off the top of their head. But it's been a huge push. I mean, off the top of my head, I think silver's up over 100% this year. And it's still at that discounted ratio to gold. So, there's a global bid for gold. It has historically valid storage of wealth characteristics. But if you look at something like gold versus platinum, right, on its scientific worth, platinum's more valuable. It's more scarce, has higher order conductivity properties. If you're using it for industrial applications, you'd rather use platinum in the circuitry than gold, but that trades at a fraction and where it used to trade 1-to-1. So I don't like buying gold. If you want to be long precious metals as part of your overall portfolio, I'd prefer a basket of molybdenum, silver, platinum, cobalt, right? Like something else that sort of tracks that category, but you're not paying that huge premium that's in gold right now.
Matt, always appreciate your time and insight, especially on set. Thank you, sir.
Thanks very much.
Coming up, we take a look at some of the top trending tickers that's on Yahoo Finance. Don't go anywhere.
Remember when inflation felt like a 5-alarm fire just a few years ago? The flames are mostly out, but the Fed is still waiting for a few hot spots to cool down, like your rent, your healthcare bills, plane tickets, and dinners out. The big question now is whether this is just a last mile of a cleanup or a smolder that could flare back up. And on today's Stocks in Translation, we're going to use the Fed's favorite inflation report, the PCE index, to see how close we really are to declaring victory. Now let's start by breaking down exactly what we mean by PCE. The Personal Consumption Expenditures Price Index tracks what you pay for almost everything. That's groceries, rent, streaming subscriptions, plus what others pay on your behalf, like employer health insurance. You might be familiar with the more common gauge, the Consumer Price Index, or CPI. PCI is a little bit broader than that and usually runs a little lower because it gives less weight to housing. Now let's take a look at its history and the latest results. This chart here goes back to 2020 and shows the main headline figure for PCE in white and the so-called core number in green. That strips out food and energy components. The Fed likes to look at core because it's less noisy and shows the trend better. But the Fed's official 2% inflation target is explicitly tied to the headline number, which includes everything. Now notice in the middle of the chart those big peaks right here. as both inflation numbers surged above 5% to 40-year highs. The Fed hit the brakes hard in 2022, raising rates to combat this. And we can see that inflation has leveled off since, going sideways since early 2024. And according to the latest numbers from September that we got Friday, both headline and core came in at 2%, 2.8%, measured from 1 year ago or year over year. So they finally converged to the same level at the right edge of this chart. Now, let's also take a look at that dotted white line here, because that is the Fed's 2% inflation target. If both the headline numbers and cores are stubbornly sticking above that line as they are, well, this is then the Fed's last mile problem. And it's about the services that you can't easily cut, like your dentist, your insurance bill, and that plane ticket home for the holidays. Now let's break down the so-called supercore inflation. When the Fed was aggressively hiking rates in 2022, Powell kept pointing to core services excluding housing. That's what we shorthand as supercore. Think of it as a wage-heavy part of the economy: healthcare, financial services, travel, dining out, recreation. If wages are running hot, this is where you see it in prices. And now let's take a look at how supercore has run since 2020. And here's the backstory. Supercore surged to around 5% in the pandemic boom in the middle of that chart again, and has come down a lot. But we just learned it's still sitting around 3.3%. It's been going sideways since last year and has stubbornly remained higher than the headline and core PCE numbers, and much higher than the Fed's 2% general inflation target. And if you look inside the latest report from the BEA, almost all of the spending growth came in September from services: housing and utilities, healthcare, financial service, dining out. The stuff that you can touch, what we call goods, those were actually flat. So to put it all together, you've got paychecks creeping higher, people still paying for services that they can't ditch, and prices in those categories just refusing to cooperate with the Fed. So what should you be watching on the inflation front into year end? First, we got a big Fed decision out Wednesday, December 10th, and Wall Street has baked in a rate cut. So the drama itself is not going to be about the move. It's going to be about the split inside the room and what Powell says at the presser and how he describes the inflation threat. We've got a block of officials who are worried that cutting too fast could light up services inflation again. And another block saying, look, growth is cooling down, so we need to ease off the brakes. And then we get a number for November CPI on Thursday, December 18th. If it comes within expectations and doesn't change too much, the markets will lean into a bigger rate cutting cycle next year, 2026, especially with the prospect of a more dovish Fed chair after Powell's leadership ends in May. Finally, keep an eye on bond yields and rate cut odds. They are the real-time vote on how quickly the Fed can tiptoe from today's services stickiness to that new 2026 Fed that the administration would just love to lean dovish. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Now time for some of today's trending tickers. We're watching movie theater stocks. SpaceX and Southwest. We're going to start with the theaters. AMC, IMAX, and Cinemark all lower after Netflix announced a $72 billion deal to buy WarnerBrosDiscovery's studio and streaming business. The potential deal raising concerns that big tentpole Warner Brothers IP could go straight to Netflix's streaming service instead of getting wide release in theaters. Joining me now on this is Brooke DePalma. Brooke.
Yeah, good afternoon. What we're certainly seeing here is these stocks move lower based upon concerns that investors have that the run of these movies would, like you said, be lower. But if you take a closer look at where exactly all three of these companies stand, they have different relationships with Netflix. And Wedbush is out with a note this afternoon that really identifies how IMAX, Cinemark, and AMC all sort of lean into these different relationships. Let's start with one that the street said has a good relationship, and that's IMAX. They said that they are planning, we know that the Greta Gerwig movie Narnia is set to come out on Christmas Day. We know that IMAX has exclusivity on that in 2026. Wedbush likes that idea. Also, Benchmark likes that idea. They said that the existing partnership between IMAX and Netflix is something that makes us a major strategic position or positive for IMAX moving forward. Now, on the flip side, they also went on to say that others like AMC, maybe not so much. They're there would be a bit of a different win here. They noted that there was also a possibility of Comcast win, which would risk shortened theatrical windows. And so really, they also said that Paramount win would be the best case scenario for these movie theaters. So obviously, it seems like Netflix sort of has a stakehold with IMAX, but for Cinemark and AMC, it maybe would have been better if one of the other bidders had won this instead.
All right, moving up next, got SpaceX in talks for a share sale that would double its valuation from $400 billion to $800 billion. That would surpass OpenAI as the most valuable private company. This is according to reports from the Wall Street Journal. And another report from The Information says SpaceX is looking at a late 2026 IPO, Brooke.
And Josh, if this is true, this would shape up 2026 to be quite the year for IPOs. We also heard that OpenAI is reportedly looking to go public as well next year. And what we know is that this would be, more than what the valuation of SpaceX that we heard the latest over the summer. And in recent, it was also make it once again the most valuable private companies. And these are two of the companies that we've been speaking about so often, OpenAI and SpaceX. Of course, keep in mind, SpaceX not only has that Starlink business, but they also have that rocket business as well, and that really has lots of people excited. And so when you think about the landscape for 2026 and what exactly this IPO market could look like, these are two top names that we've been discussing already as private companies. So definitely lots of momentum if this does come to fruition. Also that valuation, that's pretty wild.
And finally, Southwest Airlines lowering its profit guidance for the full year, citing disruption from the 43-day-long U.S. government shutdown and higher fuel costs. Southwest now expecting 2025 profit of about $500 million. That is down from the previous estimates of $600 to $800 million. Though I did see, Brooke, Bloomberg citing some analysts as saying, yes, there was a reduction in operating profit, but it was actually better than expected.
And I think also, too, what Southwest has really struggled with is competing against those major companies like Delta, like American Airlines, like United Airlines. Keep in mind also, too, Southwest primarily is known to be a cheaper airline up against United. And we've seen United and Delta do really well because they're catering to this higher income consumer, whereas it seems like they were able to sort of offset that impact of the government shutdown a little bit better. For example, Delta Airlines said earlier this week that the shutdown will cost it $200 million in profit. So obviously for Southwest, that was significantly more. So they weren't able to offset it as much as the others.
All right. Thank you, Brooke DePalma. Appreciate it. Well, the options market has been highly active in this year-end season as investors bake in expectations for the last Fed rate decision of 2025. We're taking a closer look at the action in the options playbook, sponsored by Tasty Trade. And joining us now is Title Financial Group Yield Max strategist Mike Coe. Mike, always great to see you. I want to get to some specific trades you got, Mike, but maybe start kind of big picture. Mike, you're heading to year end here. Of course, you got the Fed decision on deck. That's really kind of like the last big catalyst. So is there anything the options market, Mike, that would help us kind of just position here, given that backdrop? I mean, how do you want to be broadly positioned?
In general, we have a short fund, but in general, in our actively managed book, most of our assets are long underlying stocks, probably a lot of the names that most people are familiar with, and we tend to do options overwriting against that. I would say in terms of a big picture, and this is maybe kind of a rule of thumb that investors might just take a look at. If you're not that familiar with the options market, at least you can familiarize yourself with VIX, which is sometimes known as the fear index. Basically, all that's doing is checking the prices of options on the S&P 500 that expire in 30 days. So it's always the 30-day look ahead. And that's going to give you kind of a read of how anxious investors are. And that's obviously come off quite significantly since we saw that spike into the mid-20s just recently. And the other thing I would also point out is that, when you do see those kinds of spikes, that's often an opportunity to sort of add to your net longs, because that sort of expresses that people are getting a little bit panicky. You sort of see that fear and greed barometer swinging awfully close to fear, and that usually represents good buying opportunities.
Mike, let's get to some specific trades here as well while we got you. Ulta, let's start there. Raise the full year outlook, Mike. It looks like they reported better than expected results in the third quarter. What do you see there?
Yeah, this is an interesting one. So Ulta, part of the retail space, and actually we've seen a lot of this since November 20th. There's a lot of retail names that have done remarkably well. We've seen a lot of bullish flows. We saw some here today after they reported better than expected numbers. But as a group, I think it's safe to say that this is much better than expected. I mean, if you look at XRT, which is the ETF that tracks the retail group overall, since the 20th of November, I mean, that's up almost 12%. That's one of the best performances we've seen since that was actually introduced 20 years ago. I mean, this is like a 99th percentile kind of event. The last time we saw something like this, if we exclude like those snapback rallies you sometimes see like in the GFC and in the 2020 sell-off, was in early 2021. And so you might be asking yourself, is it now all over? Well, if you look at 2021, like that January-March timeframe, actually that rally did extend for another couple months, and it's been pretty steady that the news from most of these names has been positive. We've seen some upside call buying, and that's what we're seeing in Ulta today.
What about DG? Dollar General, Mike, reported this week, raised the full-year outlook. That stock has now soared about 75% this year. What do you see there?
Yeah, that's another one. Of course, it's coming off a really big drop that the stock had taken. This one actually comes as an almost bigger surprise to me because Dollar General tends to serve, a less affluent customer. And one of your earlier guests was talking about the pressure that sort of the lower end demographic, the lower end consumer is suffering often as a function basically of higher prices. And so these results really turned out to be a positive. So the stock is up sharply. But, some of the activity that we're seeing, a little bit cautious because they, again, probably worried about that consumer. So we are seeing some protective put buying in this one going out to December and February.
Mike, always great to see you. Thanks, sir. Have a great weekend.
Thank you.
Coming up, HPECO talks about the company's latest earnings results. That's next on Market Domination. HPE shares bouncing back after initially falling on the back of its fourth quarter earnings report. And Yahoo Finance executive editor Brian Sozzi spoke to HPE CEO Antonio Neri about the results.
It was a tale of two stories for HPE earnings day. On the one hand, revenues for the quarter came in a little light versus estimates, but the earnings call, I would argue, went very well. Let's bring in HPE CEO Antonio Neri. Good to see you, Antonio, as always. Look, take us through the revenue shortfall, because initially, I think that's where the market was focused. What happened there?
Well, Brian, thanks for having me. We had another solid performance in Q4, capping a very solid fiscal year 25, and our quarter was marked by record profitable growth, where we saw revenue up 14% year over year, maybe on the lower end of our guidance, but our operating profits were up 26% year over year, so growing faster than revenue. And then we delivered record performance on operating margins at 12.2%. And that combined allow us to exceed our non-GAAP diluted earnings per share by 2 cents at the midpoint, and most importantly, exceed our free cash flow guidance by $286 million. So what we saw there is, again, with additional Juniper, a strong performance. We are now a networking-centric company, and you can see that in the gross margin at 36%. But what I'm really pleased is the fact we've made remarkable progress in such a short period of time integrating Juniper. And that progress was demonstrated in two areas. One is, as a first combined networking business now, we grew on a pro forma basis out to the gate. And we delivered amazing innovation this past week at Barcelona, where we announced a number of breakthrough technology innovations in campus and branch switching, routing, and security. So all in all, a very strong quarter for us.
For the outlook, for the go-forward outlook, there was, some of the folks that I talked to on the street, they called out it's back-end loaded. You're expecting stronger sales in the back half of the fiscal year, as I guess pertains to servers. What is going to happen in the back half of the year? What has to happen?
Well, we reaffirm our fiscal year 25 revenue outlook of 17 to 22% year-over-year growth on the back of the momentum we had in 25 in servers. We saw in the traditional servers double digits year-over-year revenue growth. We booked another $2 billion in AI system orders, skewed to sovereign and enterprise, which is our focus. Now more than 60% of the bookings are in sovereign and enterprise. And those that take a little bit longer to recognize, that's why it's more back-end loaded. So our seasonality, including Juniper, now is 46% in the first half, 54% in the second half. So that's to be taken into consideration. But we also raised the midpoint of the networking revenue guidance now that we are confident on the milestones we have achieved in the integration to the mid-single digits. And also we raised the EPS and free cash flow guidance. Now the EPS guidance went up by 5 cents and the free cash flow guidance by 100 million. And in that guidance, by the way, Brian, we already factor in the commodity cost increases that we have seen, and we have line of sight to it. And we already enacted price increases in November. So we are very confident in that guidance. And as we said, in 2025, we will grow the company between 10 and 50%. We grew the company 14%. And this year we're going to do it again, but in a different mix with higher gross profits.
It sounds like towards the end of the current quarter, business started to improve for you or accelerate. What triggered that?
Well, we had strong performance across the three segments of the company. We saw an acceleration of order intakes in the networking business, as well as in the traditional server business. We continue to have a stellar performance in our own intellectual property in storage, where we saw 4 consecutive quarters of double-digit year-over-year orders and revenue growth. And we are very encouraged about the momentum we have. Remember, we exit the quarter with the highest backlog ever in AI at $4.7 billion. So this gives us the confidence not only on the financial commitments, but is sustained by the market demand and by our technology leadership.
You mentioned higher costs. Now I heard, and price increases. I talked to our mutual friend Enrique Lores, of course, the CEO of HP. He said the same thing. Of course, he's making PCs, you're making servers, networking equipment, sure. What is exactly happening out there? Can you get the commodities you need? And what is in short supply, and why is it happening?
Well, it comes in two places, right? DRAM and NAND. And it's driven by the hypercycle we see in the AI business. And remember, there is a technology transition from traditional DRAM to the integrated memory inside the GPUs, which is called the HBMs. And so the wafer suppliers are now constrained on capacity to meet all the demands, because the demands is not only strong in AI through the hypercycle, but also in the traditional business. But we have a very capable scale supply chain with long-term agreements. We have put forward more than 52 weeks forecast with our suppliers, and I'm confident we're going to get the allocation supply that we need. But that drives, obviously, an imbalance between supply and demand, which usually results in cost increases. And we already saw that in calendar Q4, and we already implemented price increases and expect to pass the vast majority as we go into 26. Now, the NAND portion of that will follow as well. But remember, now being a more networking-centric company also allows us to be less dependent, because those commodities don't have the same impact in the networking business.
Have you started to take business away from Cisco?
Well, we have, as independent companies, we have taken share in the campus and branch. We are the company that shipped the most wireless access points year to date. And with our differentiation now in the AI ops, we believe we will continue on that journey, and there will be a refresh coming up on the campus and branch switching. And so what we announced this week at the HP Discovery in Barcelona is the cross-pollination between Aruba Central and Mist AI. So both will get the best of both platforms. And we are also introduced the first dual infrastructure set of products that whatever journey you were on, whether Aruba Central or Mist AI, it will be supported with the same product infrastructure. And also we introduced the first industry liquid cooled 1.6 terabit switch So time to market with data center switching is super important. And that's because now the networking team and the leadership for Rami has the benefit of accessing direct liquid cooling from our server business, which for others will take a little bit of time, in addition to all the other announcements on AI for networks with AI Ops, agentic AI with our GreenLake platform. So super, super excited. And I'll tell you, the customers that we had in Barcelona, which were more than 5,000, record breaking, were so enthusiastic about us building a new networking leader.
All right, well, take that, Cisco. Look, Antonio, since we've talked, there's been more or increasing talk about an AI bubble. Now, you are literally, I need your stuff to build out AI infrastructure in this country and around the world. Do you think the talk of like this type of talk makes any sense based on the orders you're seeing, demand you're seeing, customers you're talking to, other CEOs you're talking to?
Well, I will say demand continue to be unabatable, and that's because I see now the adoption of enterprise rising. I give an example in my own company here. We have more than 100 use cases already in production using large language model or agentic AI models. And then obviously sovereign is accelerating. In Europe, you can see it, the need for sovereignty, the need to protect the data, the need to build their own models is growing very, very rapidly. And then on the service provider space, whether it's hyperscalers or neo clouds, we see that continuing. And then the United States is investing pretty heavily in building the capabilities. And we already won 5 large AI and supercomputing business with the US government in the Department of Energy, which are going to be breakthrough systems that will continue to put the United States ahead of the rest of the world. Now, how you finance that, how you build these massive data centers, is you have to be prudent, right, where the funding comes from. But we as a company are very prudent in managing our working capital, so we are not exposed to any of that. We just focus on profitable growth where it makes sense for us.
As a company, as a very large tech company, of course, Antonio, are you concerned about circular financing?
Look, there is all sorts of speculation out there, where the financing comes from and so forth. What I can tell you is the raising of capital continues, but we as a company obviously have a HP Financial Services arm that are focused only on enterprise customers because that's the market we serve with our IT asset lifecycle services. And so definitely, there are risks out there. But right now, I will say that the demand portion of the risk is very, very minimal.
Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.